What is Bitcoin? Is Bitcoin still a good investment in 2024-2025? In 2008, a programmer named Satoshi Nakamoto published a 9-page paper outlining a new decentralized digital currency. He called it Bitcoin. Bitcoin, introduced in 2008 by an anonymous creator known as Satoshi Nakamoto, is a decentralized digital currency that is exchanged over a peer-to-peer network without centralized authorities. It is the world's first decentralized cryptocurrency to use blockchain technology to secure and authenticate transactions. The Bitcoin network is public and open source, meaning that anyone can participate. Bitcoin combines a network, a cryptocurrency, and a blockchain to record transactions transparently, prevent double spending, and ensure consensus through a process called proof of work. What is Bitcoin? Bitcoin is the world's first successful decentralized cryptocurrency and payment system, launched in 2009 by a mysterious creator known only as Satoshi Nakamoto. The word cryptocurrency refers to a category of digital assets in which transactions are secured and authenticated using cryptography, the scientific practice of encoding and decoding data. These transactions are often stored on distributed computers around the world using a distributed ledger technology called blockchain. Bitcoin can be broken down into smaller units called Satoshi, up to 8 decimal places, and used for payments, but is also considered a store of value like gold. This is because the price of a single Bitcoin has risen significantly since its inception, from less than a cent to tens of thousands of dollars. When referring to Bitcoin as a market value, it is represented by the token symbol BTC. The term decentralized is often used when discussing cryptocurrency and simply means something that is widely distributed and does not have a single central location or controlling authority. In the case of Bitcoin and many other cryptocurrencies, the technology and infrastructure that governs its creation, supply, and security is not based on centralized entities such as banks and governments that manage it. Instead, Bitcoin is designed so that users can exchange value directly with each other through a peer-to-peer network, a type of network where all users have equal power and are directly connected to each other without a central server or intermediary company acting as an intermediary. This allows data to be shared and stored, or Bitcoin payments to be sent and received seamlessly between parties. The Bitcoin network, capital B for the network and technology, lowercase b for the actual currency, Bitcoin, is completely public, meaning that anyone in the world with an internet connection and a device that can connect to the network can participate without restriction. It is also an open source system, which means that anyone can view or share the source code on which Bitcoin is built. Bitcoin is perhaps the easiest way to understand that it is like the internet of money. The internet is purely digital. No single person owns or controls it. It is borderless, meaning anyone with electricity and equipment can connect to it. It works 24/7, and people who use it can easily share information with each other. Now imagine if there was an internet currency where everyone using the internet could help secure it, issue it into circulation, and pay each other directly with it without a bank. Bitcoin is essentially just that. Nakamoto originally conceived Bitcoin as an alternative to traditional money, with the aim that it would eventually become a globally accepted legal tender that people could use to buy goods and services. However, Bitcoin's usefulness for payments has been somewhat hampered by the volatility of its price. Volatility is a word used to describe how much the price of an asset changes over a period of time. In the case of Bitcoin, its price can change dramatically from day to day, and even minute to minute, making it a less than ideal payment option. For example, you wouldn't want to pay $350 for a cup of coffee, and 5 minutes later it's worth $430. Conversely, it also doesn't benefit merchants if the price of Bitcoin drops dramatically after you hand over your coffee. Bitcoin works in many ways in the opposite way to traditional money. It is not controlled or issued by a central bank. Its supply is fixed, i.e., new Bitcoins cannot be created at will, and its price is not predictable. Understanding these differences is key to understanding Bitcoin. Is Bitcoin still a good investment in 2024 and later? The emergence of new Bitcoin ETFs provides an easier pathway for traditional investors, who typically deal with stocks and bonds, to venture into the realm of cryptocurrency. Instead of navigating separate accounts with potentially high trading fees, these investors can now seamlessly integrate Bitcoin into their existing brokerage accounts alongside their other assets. Matthew Siegel, who heads digital assets research at VanEck, an investment firm offering one of these new funds, sees this development as a significant advancement. He emphasizes the cost-effectiveness for retail investors and enhanced security for institutional purchasers, which he believes will drive substantial demand. Furthermore, Siegel anticipates that advisors catering to high-net-worth individuals and institutional investors will soon incorporate crypto into their portfolios, although current limitations prevent them from doing so directly. However, he notes ongoing preparations by banks and brokers to integrate Bitcoin ETFs into client portfolios later in the year. Additionally, the future holds promise for a variety of crypto ETFs, including those tied to other cryptocurrencies like Ether. Todd Rosenbluth, head of research at VettaFi, predicts a diverse range of ETFs that may combine Bitcoin with mainstream investments such as the S&P 500. Moreover, he foresees the emergence of more complex strategies, such as funds using Bitcoin holdings to hedge against other investment performances. According to Stéphane Ouellette, the recent surge in Bitcoin's price may seem significant for traditional assets like stocks or bonds, but it's not particularly remarkable in the world of cryptocurrency. Ouellette, who is the founder and CEO of FRNT Financial, suggests that despite speculation surrounding the introduction of Bitcoin ETFs, various indicators used to assess market cycles indicate that the cryptocurrency market is still far from experiencing the widespread hype and frenzy typically associated with a fear of missing out phase. Ouellette points out that metrics such as Google Trends, searches for Bitcoin and cryptocurrency, financing for crypto companies, and investor trading volumes remain relatively subdued. Therefore, if the crypto market is indeed heading towards another bull trading cycle, it's in its nascent stages. However, this doesn't imply that it's an opportune time to heavily invest. Bitcoin experts aren't advocating for investment solely due to the ETF rollout. Rather, they believe in Bitcoin's potential as a long-term store of value and as an alternative payment system, especially in developing nations. Moreover, they envision a future where blockchain technology becomes more integrated into the U.S. economic ecosystem. Nevertheless, there's no guarantee that this vision will materialize. Additionally, cryptocurrencies don't adhere to the same fundamental principles as stocks do. Their prices are primarily driven by investor speculation. Therefore, before considering adding crypto to your investment portfolio, it's crucial to evaluate how it fits into your financial objectives. Ouellette suggests assessing the role it can play in achieving your goals and adjusting your investment allocation accordingly.